Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about the impact of volatility, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's course.
I'm going to draw a risk graph, and this will be at the money. And then I'm going to show you the at expiration shape of a butterfly that we're all familiar with. There's one spread here. These are the short strikes. There's two short strikes. There's one long here, and then one long here. So it's made up of four. At the beginning of the day, the premium will look like this. And eventually, it's going to be increasing like this, and then finally up like this until it fills up at expiration and takes the shape of that cyan line. So it's constantly moving throughout the day. Now, the rate at which it moves, in other words, if we were to map this to time, and time zero maybe being at the market open, maybe at 9:30, right? Maybe this right here is 12, and maybe this here is 2 o'clock, 2 p.m. And then it will continue to move up like this. Maybe this is at 3:30. This is all an example. So it's moving at actually an exponential rate. It's getting faster and faster as it comes up. Now, the rate at which it moves up at first is very slow. So this might be the first hour. Then the second hour is a little bit longer. And the third hour, a little bit longer. And then like this. So it's moving at intervals that are getting larger and larger. So the premium is growing like that, right? So let's say that this is the premium. Now, the rate of growth is ultimately dictated by time. Each one of these levels would represent maybe an hour, maybe 12, 1, 3, 12 o'clock, 1 o'clock, 2 o'clock, 3 o'clock. The size of that and how early that we get that volatility, we're at the starting point. See, this is the starting point. Now, this is going to get a little crazy here, but bear with me. The starting point is the debit. And that starting point at 9:30 is largely determined by the amount of volatility that I showed you before, whether it's super low or super high. When volatility is super high, that starting point and the size of this debit, that green one, is small, let's say 1x. When you go into low volatility areas, that starting point is about 3x. So let's visualize that with two side-by-side butterflies. We'll do a low volatility starting point or a high volatility starting point and a low volatility starting point. So in normal times, like it has been for the last 3 years, we had butterflies that look like this. But now that same butterfly, same width and everything, looks like this. See how much lower it is in the market? So the premium is starting at a different point. It is on that 0 DTE day, the amount of premium that is preloaded or into the fly is greater on a low volatility. This is low volatility, and this is high volatility, or relatively high. Let's call this normal volatility. We'll call this normal volatility, and this is low volatility. Now, normal volatility is prices moving back and forth like this. It has a nice range to it. In the low volatility era, the price range is very small. In the normal volatility, we can stand to have 30 wide to 40 wide on the SPX. In the low volatility regime, we can only have, say, 15 to 25 wide. And that's because the amount of range that price is going to move and also the premium, right? So these are going to cost way more. These are much more expensive. These are much more expensive relative to the amount of premium that's in them to get into. And these guys, these guys over here are cheap. Now, part of this is because this first leg in the morning is much bigger in the low volatility era than in the high volatility era. Now, there are times on individual days where that volatility is elevated. It'll force this up a little bit. And on these days, it's already up there. It's not going to really force it that much. It can force it a little bit, but it's already preloaded. There is some point when you get up around here that we call the event horizon, right? And that's somewhere between here and here. And it's the same on both of them. There's a point where volatility no longer has an effect on how much premium has been preloaded into the butterfly. And so that's what we're really interested in. We're interested in what is the optimal time that we can get into these trades so that we can take advantage of as much of that premium decay as possible. And at the same time, we're playing the back and forth. This is a multi-dimensional problem when you're trading options.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.